Thank you for joining us on our presentation on 3 big retirement risks that you all face. My name is Flowers. I'm with Wealth Financial Services and Tax Advisory, a comprehensive financial planning firm that does everything from retirement income planning to estate planning to tax planning. Today we're going to go over a lot of hypothetical examples which may be a great fit for you and your family. But until you talk to a professional that knows your individual circumstances, please do not act upon any of these recommendations. After this presentation, feel free to reach out to me via phone or email, and we can schedule a complimentary consultation to see if these strategies can work in your own financial plan. With that being said, let's go over the presentation. You have 3 big risks in your retirement. One is structural risk. Where can you put your investments at today that's going to give you good returns but not take too much risk to do so? The second risk you have is market risk. You can put your money in the market, but you're subject to the fluctuations. And we've seen in 2020 how fast that market can drop. Are you relying on the market to depend if you have a good or bad retirement? We do not want our clients to rely solely on the market to enjoy their retirement plans. Tax risk. We've seen this national debt spiraling out of control. We just got a big stimulus package, yet we're historically in the lowest tax brackets of U.S. history. If you're like me, you think taxes are going to probably go higher in the future. In the law today, in 2026, tax rates will be increasing. What are you doing to prepare for that now? Most accountants and CPAs, they try to reduce your tax liability for this year. My goal is to change the way you think about that. Think about tax planning and looking how can you pay the least amount of taxes over your lifetime. And we're going to give you some ideas and strategies in a second. So with that being said, you can go to a bank right now and get savings accounts and CDs, but those rates are not even keeping up with inflation. And if you have them in a taxable account, every little bit you make, you have to pay interest on that, and that diminishes your returns when it comes to tax time. So probably not the best place to put your money today. You need higher returns that kind of keep up with inflation in retirement. Well, you can get higher returns in the market, but the market's very volatile, ups and downs. And are you solely relying on the market to have a good or a bad retirement? We do not want our clients to solely rely on the market because it is volatile and it has lots of risk. And say the market has a downturn and you need to take out money, that could dramatically affect your retirement plans. Tax risk. If you're like most people, you've been told defer in your 401ks because when you retire, you're going to pay less taxes and your income will be lower. Some of you know that that isn't always the case. You've done very well in your 401ks and those assets have grown, and now when you take out distributions, you might be in the same tax rate or even a higher tax bracket than when you were working. Let's look at this example though of Tom. He is using the old approach. He's been putting money away, $7,500 a year for 30 years into his 401k. Each year he did that, he saved $2,500 in taxes. And over that 30-year span, he got $75,000 of taxes saved. Doesn't seem too bad. But the problem is when he deferred, that money is still growing, and now he has a bigger pile of money that he has not paid a dime in taxes on. So now he retired and he starts taking out $75,000 a year. He did that for 15 years. He paid about $25,000 of tax liability every year he took that out. And over that 15 years, he paid $375,000 in tax liability. Looking back, Tom probably was better off not deferring as much in taxes because he actually paid more in taxes over his lifetime. So if you find yourself in this situation, you may want to consider doing a Roth IRA. When you put your money in a Roth IRA, you don't get the tax deduction this year. But all that future growth is tax-free forever. So you're paying the tax on the seed, and then letting that money grow tax-free. In a traditional IRA, you get the deduction this year, but then it grows and you pay the tax on the harvest after 20 or 30 years. With today's low historic tax rates, I would really consider doing a Roth IRA in your 401ks at this time and point. Now, in our tax code, Title 26, you probably didn't know, but that's where the 401k is located in our tax code. And in the tax code, it says the government's giving you provisions to put money in today, to save taxes today, let that money grow over a period of time, and then they're going to force you to take that money out. Right now, the age is 72. That changed since the Secure Act went into place. Why do they force you to take the money out? Because they want their tax revenue. Who controls how much you pay on that? Well, the government controls the tax rates, and none of us know what the tax rates will be in the future, but I personally think they'll be much, much higher. So these are 401ks are government controlled accounts because they control when you take it out and how much you pay in taxes. Now, you may not have also known that there's a section in our tax code called the 7702. In this section, you can grow your assets tax deferred, but then you can take those assets out tax free. Now, in your 401k and IRA, you have an age restriction where you can't touch that money till after 59 and a half, or else you're penalized. Well, in section 7702, there is no penalty for early withdrawals. You can take that money out whenever you need it. Also, there is no required minimum distribution in 7702. You can delay to take that at 75, 80. You control when you take that out. In a 401k, you're also maxed out on how much you can put into that per year. In section 7702, you can put as much as you want into that and not have any kind of cap or limit to that. Why haven't you heard of section 7702? It's in the tax code, but many people are actually taking advantage of this, but few people talk about it. What is it? Well, it is Index Universal Life, or life insurance. Life insurance not meant just to pass on wealth to the next generation, but life insurance that you can benefit from while you're alive. And we're going to go over some ways you can do that. One thing it does, it gives you the power of indexing. It gives you the power to take the market competitive returns, but not take any of the market risk to get those returns. And we're going to go over in more detail. It gives you the ability to take out tax-free income, whether that be for your retirement, for college funding, to buy a new car. You have full control when you want to take that money out, and that money is tax-free. On top of that, it also is life insurance, so it has a death benefit, which could protect your spouse or make sure wealth transfers to the next generation. One other benefit is it actually can give you long-term care benefits, where, God forbid, you go into a long-term care facility, you can access part of those funds tax-free to pay for those claims. A lot of benefits packed into one IUL, Index Universal Life Insurance. Let's talk about indexing. If we look here, here's the market over the last 19 years, from 2000 to 2019. There was almost a decade where you didn't make anything in the market. But if you stayed invested throughout that time period, you got up to 6.06% average rate of return. But you took a lot of risk to do so. Now, what if we could hypothetically eliminate all the negative years? But on the flip side, we only can make up to 11.5%. How would that look? Well, if we minimize all the negative years, and we can replace those with zeros, and we only can make, on the positive side, 11.5%, we are actually almost at the same place as if you were in the market. This is how a universal index life insurance policy works. You get the upside competitive returns, but none of the downside market risk. There's always a trade-off though. You're not gonna make 20% in this contract. You're gonna make a portion of those gains, but you're also not gonna have any losses and no market worries or stress when the market has a correction. Something that many people should be taking advantage of right now in their retirement. What the power do you have? Well, you have the power of today. Today is the time to do things and make decisions, because if you delay even 5 years, you could have 40% less income. If you delay just 1 year, that can reduce it by 11%. Another thing about this IUL is you have to be relatively healthy. You might have your health today, but in 6 months or 6 years from now, you may not be able to qualify for this. If you are relatively healthy and you like this concept of using the tax code to your advantage, I highly encourage you, give me a call, see if there's anything I can do to help give you some more information or help tailor a plan for you. Obviously, I talked about this strategy. We do lots of things at our office. Like I mentioned, income planning, tax efficient investments, life insurance, Social Security, tax preparation, but more importantly, tax planning. We do Medicare supplements, we do estate planning, and we do all these services under one roof. I encourage you to give us a call, try us out, see if we can help benefit you and your family in the future. Thank you for watching.